Good morning, good afternoon, and good evening. Welcome to the Supply Chain Risk Management Consortium's first in a series of webinars on the Prescriptive Online Supply Chain Risk and Resiliency Assessment. Today, we will focus on the assessment's ability to support your yearly strategy planning, often called strat planning. The assessment takes less than 30 minutes of your leadership's times to build that aligned action plan tailored for supply chain risk and resiliency. We look forward to an interactive webinar consisting of polling questions. Please have your cell phone handy or have another window open in your browser and log into Poll Everywhere. And the website is in the chat box, pollev.com/Greg Schlegel 910. My name is Jim DeVries, founder and president of Enhance International and partner of the Supply Chain Risk Management Consortium. I will be the host of today's webinar. We also have with us Connor Fitcham, who will helping us from Uphaven, South Africa, to help facilitate today's webinar. So reach out if you have any questions, please. Joining me today, of course, is Greg Schlegel, and he will be sharing his vast expertise. Greg is one of the original founders of the Supply Chain Risk and Resiliency Concepts and former president of Apex ASCM. He founded the consortium in 2010, and Greg is a celebrated speaker, esteemed author of the book, Supply Chain Risk Management, an Emerging Discipline, published in 2015. Greg, a few words.
You bet. Thanks, Jim. Great to be with you folks today to talk about our passion. If you've been with us before, pretty much a passion of ours. I'm the founder of Supply Chain Risk Management Consortium. As Jim said, we've been in business a little over 12 years. More about that in a minute. I've taught supply chain risk management at Lehigh University here in the States for 10 years, and I still teach ERM, Enterprise Risk Management, at Villanova University here in the States as well. Spent 8 years with IBM as a supply chain executive consultant and practice lead. I spent 30 years, like perhaps many of you, as a supply chain exec for several Fortune 100 companies, and I've taught supply chain management at 6 different universities here in the States. So with that, I'll turn it back to Jim, and we'll begin.
Great, Greg. Just an overview of our webinar series. This is the first of 6 webinars, and we're focusing on this first webinar on supply chain risk resiliency to support your yearly strat planning and aligning those priorities to that AOP. Our second webinar will focus on one of the first tools, the maturity model. Then the third webinar will focus on risk appetite. Our fourth webinar, operational propensity, how do you operate, sometimes called culture. And then next year, we'll get into the action plan and building that tailored supply chain risk and resiliency action game plan for your company. And our sixth webinar, of course, is how to make this a priority for your company. We welcome your feedback on these webinar series. Love to get your feedback on if this helps and is aiding you in your supply chain journey. Our agenda today is first integrating the supply chain risk and resiliency program deliverable into your annual budgeting process. And then our second part of the webinar is giving you an overview of the maturity model, risk appetite, and cultural kite, where you are, who you are, and how do you operate. Our third deliverable is about exposing your risks within your business objectives, accelerating your time to value, and the integrated action plan. And then our fourth, to wrap it up, are the program requirements. So with that, Greg?
You bet. Thanks, Jim. We thought we'd start with just a real quick introduction of the Supply Chain Risk Management Consortium. So if we move on, you can see on the right-hand side a quick profile of who we are and what we do. On the right-hand side, we now have 31 companies. We're still growing. That's about 1,500 supply chain risk professionals around the globe. These companies that you see on the right bring tools, techniques, methodologies, solutions to help us identify, assess, mitigate, and manage supply chain risks for you. On the left-hand side is what we provide. We kind of think of them as 5 product service areas. Top to bottom, online education. We have 2 certificate courses that are self-paced online, pretty much a body of knowledge of our book. We do coaching and consulting. We actually provide software as a service platform solutions, as you can see on the right. And then we're very excited about 2 new online assessment tools. One is supply chain management online readiness assessment, which gets into evaluating the maturity of your supply chain processes. And the one on the bottom, brand new, is a prescriptive online supply chain risk and resiliency 90-day action plan, which we are going to focus on today, again, aligning it with your AOP process. So with that, I'll turn it back to Jim.
Thanks, Greg. And just to give a little background of myself, the EIG is an exchange of passionate experts to guide your transformation. Our company has over 50 consultants, consulting companies, and SaaS providers focused on enabling your enterprise. EIG offers to be your master integrator to provide you access to the best and brightest companies. Our team is dedicated to empowering your organization's workforce by leveraging EIG's partnered tenured experience. Our goal is to provide collective, collaborative, experienced thought leadership to enable organizations to deliver self-sustaining positive margin growth, the competitive advantage with 90-day action plans with clear return on investments. Looking at the bicycle slide, which we love, the EIG model is modeled as a company's ecosystem within 2 wheels, linking strategy to execution. The 2 geared wheels are connected by a chain, with the strategy wheel being larger of the 2. The 2 geared wheels are inexplicably linked and are in sync. Otherwise, of course, you become derailed. Developing an agile supply chain mindset will ensure that you're successful on your journey. The front gear strategy moves at a slower rotation speed than the rear gear execution. A solid strategy will result in, of course, many execution rotation cycles. In summary, a strongly linked strategy to execution ecosystem results in positive momentum for the company, its employees, customers, and stockholders. Quoting Albert Einstein, "Life is like a bicycle. To keep your balance, you need to keep on moving." So let's get moving with the webinar here. So our first topic today is integrating the supply chain risk and resiliency program deliverable into your annual budgeting process. So we're going to start off with some background here on the strategy integration using the SCORE model. And for supply chain practitioners, ASCM's supply chain operational model, SCORE, has a wealth of best practices. It was developed in the 1990s and early 2000s. It started as plan, make, source, deliver, and return, and has expanded to what you see here on the graph. Over the years, we've incorporated some new areas, the innovate and build processes, as well as marketing and sales, thus incorporating the true end-to-end customer, best practices for centralized services, sometimes now, excuse me, sometimes now called global business services. That's a pretty hot topic today. And it was started in the late 2000s. So that has incorporated. This has started the transformation from human resources that we used to call to talent management, information technology, we used to call it, and now it's called digitization. And we combined it and then separated it. In the last to join the model is strategy, which SCORE calls align, and the latest area to be defined is, of course, ESG. It's hot in the news, environmental, social, and governance, which is really a culmination of some of these centralized services. Aligned is positioned so that the blueprint model has a beginning, an end, and an initial representation of workflow interaction with the other enterprise work processes. Greg will now share us some key definitions of the VUCA world. Greg?
You bet. Thanks, Jim. We wanted to share with you something that's going on, and hopefully all of us, we wish we didn't experience this, but we all live in the VUCA world. And what does that stand for? Well, V is for volatility. Definition. This describes something that is liable to vary or change, sometimes very quickly and often for the worse. What is that? Those are our infamous government lockdowns. We've all been impacted by that around the globe. U stands for uncertainty. This is a state of not knowing or being able to rely on something. And what is that within our world? That is supply and demand shocks. For the first time ever, we have had both simultaneously due to the lockdowns and the pandemic. Next, the C is for complexity. This can be defined as something with many parts in an intricate arrangement. What is that? That is our global supply chains. We all have them. You don't have to be $1 billion company to have a global supply chain. Why? Because of the internet. And then finally, the A is for ambiguity. That is something is ambiguous if it is open to more than one interpretation. What is that? That is adding up all the elements above: volatility, uncertainty, complexity. And this is our landscape at the moment. We have more. All right, this is our point of view when it comes to supply chain management. Still pretty linear at the moment, but if you go top down, left to right, you basically start with raw materials, components, and or sub-assemblies. You have manufacturers, even contract manufacturers. You could have a retail outlet, and then we end up on the right-hand side with the consumer ultimately. On the left and right side of this graph are what we call threats and risks associated with the linear landscape. All right. Our theme at the bottom is integrating voices from different parts of the supply chain, and it's vital for success. So we wanted to give you essentially a roadmap of how we look at supply chain and the risks associated with those elements of the supply chain. We have more. Next is we wanted to share with you insights from this McKinsey report of 2010. They've done a very good, extensive, deep dive analysis across many industrial sectors on the bottom right relative to supply chain shock exposure. And so on the right-hand side of the graph, on the y-axis, from bottom to top, you have low impact, low projected shock value up to a high shock value. And they've gone through algorithms to evaluate that by industry based on whether you're global, whether you're resource intense. In the middle, you can see the color code of the charts. And we wanted to share that with you. If you can find that McKinsey report, is very, very interesting reading, folks, because they go across almost all basic industry sectors. The net of this slide on the left-hand side is the quote from McKinsey in terms of why investing in supply chain resiliency pays off. And their quote is basically, we thought it was pretty good. The COVID-19 pandemic has once again driven the necessity of managing operational and supply chain risks. It's catapulted these issues to the top of CEOs' agendas and the unexpected now has to be considered probable. So with that, we wanted to share a few data points with you, and I'll turn it back to Jim.
Thanks, Greg. And we'll move on here to a summary of the disruption types by industry in the first half of 2022. And that's from our partner, Resilink. And on the left-hand axis here, you have the number of instances. And on the Y2 axis, you have the increase rate percentage. And as we saw with Greg's VUCA definition and why investing in a supply chain risk management pays off, we are looking at this for the first half of 22. And the most significant increase in disruptions has been from the SaaS providers. So as you can see, you have the different areas on the x-axis, and they're seeing the greatest impact recently this year. But if you look at the remaining different groups, packaging, industrial chemicals, high tech, and so forth, you see it's relatively about the same, although you can make the argument that healthcare and life sciences are seeing slightly more than the remaining areas. And the real question is, and something for you to put in your chat here is, are disruptions increasing in your business? So as you can see, according to Resilink and their customers, they're seeing quite a bit of increase over last year. 50 to 200% increase is quite a bit. So we'd love to get your feedback on what you're seeing. The next thing we want to cover is, this is just a typical company. This is actually even pre-COVID, which is interesting. And what we have here is year-over-year costs. So if you look at your annual operation plans, you often look at year-over-year, how are your costs, both your variable costs and fixed costs. So the solid lines are cost of sales for variable, which is gray, and fixed is green. Solid lines, I guess it's gold. And then your dotted lines are with your variable of distribution costs. So as you can see, there's quite a bit of volatility here for this particular customer of ours. And so the question is, there might be a few surprises throughout the year. And you could imagine being in their quarterly reviews or being a fly on the wall to hear the excuses and laments of not being able to predict performance. So if you have anything that assimilates this, maybe not so bad, maybe just as bad, these are risk events that are often causing these storied changes in the output. If this happens in your business in pre-COVID, you could only imagine what that is intensified. So getting ahead and being proactive on your risk planning, which is what we were brought in to do to help them smooth this out over time. So the question often is, how often do you have to change your annual budget? Meaning throughout the year, if you're changing your budget, your annual budget for that year on a quarterly basis, you kind of know that the disruptions are running your business, you're not running the business. And that's really where we would want to come in and help and support you on that journey. So what is the annual operating plan? So we just put together what we see often, and very often this is not the case, but these are 5 steps that you would want to be driving throughout the year, starting in June or July through August, all the way through the end of the year in November. So let's start it off with the corporate strategy, getting your vision, goals, strategy, initiatives for the whole entire company aligned. Then you have your business units coming up with their plan and strategy, which will be most likely geographical as well as business led, and then align those to your centralized services functions, planning, tax, supply chain. And then what we espouse is an overlay of that to look at your overall risks and apply our basic supply chain risk and resiliency strategies to that, which we espouse in our 90-day plan, and then into resource readiness and driving that throughout your organization. So again, these are 5 steps that we have laid out here. We'd love to hear what your 5 steps are. You can certainly put those into the chat, or kind of lay out how often you are doing your annual operating plan. What does it look like? Just getting you to think about that. And then how do you fit supply chain risk and resiliency into that plan? With that, we have our first polling question: how long is your overall annual operating process? Is it less than 3 months? Greater than 3 months? Could it be 3 months, 4, 5, 6 months? Do you do it throughout the year? So love to get your feedback here. We're going to go ahead and look at this. Some of the responses, we see some at 3 months, some at 4 months. I've seen 6 months. I've seen 8 months in my past life. There's no right or wrong. It's what your company does. Greg, a few words.
Yep, Jim, I'm not surprised about that. From my practical point of view, as a practitioner, 3 to 4, the kind of timeline that we put up in the previous slide, starting in around June, July, and August, when everyone starts to fight for funding and fight for initiatives to put together a concerted annual budget. So all good. Again, as Jim said, there's no right or wrong answer. We just wanted to poll the audience to see what you are living with at the moment. So thank you.
Thanks for your feedback. And again, feel free to ask any questions in the chat. Greg?
Yep, you bet. We thought we'd go to the next section, and that is supply chain risk and resiliency program overview. So we wanted to give you a sense of the elements of this assessment process. So with that, we can move on to the next slide. We thought we'd start with giving you kind of a definition of what is a resilient enterprise from our point of view. This comes from our book. We think this is the best definition we've seen in a good long time, so we injected it in the booth and cited where it came from. But the definition is this: a resilient enterprise has the capacity to overcome disruptions and continually transform itself to meet the changing needs and expectations of who? Customers, shareholders, and other stakeholders. Now, we'll be honest with you, that's a pretty tall order when you talk about all types of risks, but we think it's important, and especially important at the moment, injecting, embedding, thinking about the risk dialogue when you begin your AOP process. So with that, we'll keep moving on and give you a thumbnail sketch of this journey in terms of the assessment methodology. Start with maybe strategy, developing and leveraging the supply chain risk and resiliency. We advocate using it perhaps at a business unit with cross-functional folks. It's an online survey, takes you no more than 30 minutes per person to answer the questions. We'd be more than willing to, and we do this joint planning virtually. We can do it virtually and or face-to-face in terms of leading, guiding, directing, and coaching. And we have an action plan coming out of the assessment methodology that can be aligned to your AOP. So with that, the elements look like this. You fill in the survey. You get 3 different types of computer-generated charts. One is where you are, what your position is as is today on our 5-stage maturity model. And we'll talk about that in a minute. The next one is who you are, which is really geared around what type of risk appetite does your company have today. And the third chart, as we move left to right, is how do you operate? We call it basically, what's the shape of your kite? You can see the kite there. That's basically the culture of your operation. And then we provide a 90-day set of action plans that are aligned to those three dispositions in terms of risk management. And then the process is below. We advocate a lead, some type of project lead. We basically ask for a minimum of 5 to 8 stakeholders completing the survey across multiple disciplines, and then the process of feedback in the middle. Once we produce a report for you from an AOP risk point of view, you get the report, and then we go through the checkpoint calls of 1 hour each or more. We confirm that you have the report and answer any questions you might have initially. Then every 30 days, we tend to either visit you and or talk to you virtually to ask, did anything work? What did you do? Did it work? What's the pulse check? Get a temperature check the next 60 days. And then in 90 days, if you complete those action items, what do we do? What do we do next? So remember, the goal of this process is to make everyone in your organization aware of the risks within your business objectives. That's the goal that we're shooting for. And this process also includes 40 hours of consulting. So with that, we'll move on, talk a little bit about the elements, focus in a little more, excuse me, on the elements of the process. This is our supply chain risk and resiliency maturity model. Has 5 stages. On the left side, on the y-axis is your supply chain risk and resiliency maturity level from low to high. On the x-axis, from left to right, is your competitive advantage over time from 0 to infinity. The 5 stages, real quick thumbnail sketch. First one on the left, foundational. That's nothing more than education first and making you aware of these best practices. All right. So you got to start somewhere. Next is visibility. That's second. We think it's important. We mean visibility in your supply chain going upstream to your suppliers and downstream to your customers. Because remember, what you don't know about your supply chain can and will hurt you. The third is predictability. Might not be exactly what you're thinking, but it's more digitizing your supply chain. Why? We advocate digitizing a supply chain, put it in a model, and then perturbate that model, run what if scenarios, so you can see how your existing supply chain will react to risk stimuli. Fourth is resiliency. This is where we advocate you embed tools, techniques, methodologies, and solutions into your daily supply chain exercises or lives, transactions. And then finally, sustainability. We're not talking about going green, even though the box is green. We're talking about scaling. If you do all this work, how can you scale this good work relative to risk management across other divisions and other product lines? On the bottom, we superimpose a risk heat map. Basically, we say if you're in foundational and visibility and you're early on, you're probably at high risk to your supply chain. As you move up the maturity model, we basically say you can mitigate and lower your inherent risks associated with your supply chain. And then Jim plopped up our mantra: identify, assess, mitigate, and manage risk. And then we always like to ask the question, where are you? Where do you think you are in our 5-stage model? And we have some more. We'll go into the second element. This is what we call our risk appetite frontier. It's a framework. On the y-axis in the middle there, from bottom to top is your risk viewpoint. How do you view risk from an organization? From 0 to 0.5, we kind of think that's a risk averse area where you think about risk in a negative point of view. From 0.5 to 1 on the top, a lot of companies think about risk as a risk opportunity. So, that's the framework of the y-axis. The x-axis is what we call management decision tactics. You could do nothing. That's a tactic, that's a decision. You could be into loss control, risk steering, diversifying, and risk acceptance. Those are the tactics that tend to be associated with what you see as the 4 risk perspectives. And we'll give you a quick thumbnail sketch now. The first, the pragmatists, the orange. Pragmatists, you can see where they reside on the 2x2 graph. They tend to wait until the very last minute to decide relative to a risk decision. They're basically reactionary. Remember, there's no right or wrong answer here, just different. This is a perspective on risk. The next, the conservators, dark blue on the bottom. Their biggest concern is avoiding a loss. They're very careful to avoid a loss to the bottom line. So you can see they're somewhat risk averse. The third, the light blue in the middle, managers, they carefully balance risk and rewards. They do a lot of cost analysis. They utilize many tools and techniques to quantify risk and make an informed decision. And then the purple are the maximizers. These are the big risks, big rewards. You remember that. They go for the gusto. These folks are proactive. They perceive risk as an opportunity, and they tend to go after those risks because there's big reward, and they want to get them as early as they can before their competitors, exercise that option. So we gave you 2 out of 3. I'll move it over to Jim, and he'll talk a little bit more about the third element. Jim.
Thanks, Greg. Our third element here is operational propensity, and with a description of how to navigate the resilient enterprise journey and who are you within the operating frontier. We'll look at it more from an agility or operational propensity perspective, sometimes called culture. So the question is, where are you and where do you want to be in this from this perspective? We are seeking to understand the leadership's commitment for the transformation to build and evolve a scaled framework into a resilient enterprise. So from an AOP perspective, we're really looking at how are you going to navigate those improvement changes along your strategic objectives, and what is your operational propensity for that? So we have some axes here on the top right. Our axis, as you see, is you have a speed index from slow to fast. You have a external focus and differentiation from narrow to broad. You have an agility axis here from strong to weak, and a stability and control from collaborative to efficient. And for the operational propensity, we have what we call personas, and we have these 4 quadrants, you could call them. And the first is bureaucratic. And for the bureaucratic, it's all about controlled coordination, efficient stability, controlling orientation with slow speed to efficient stability control. And then moving to the left is the trapped, which tends to be your clannish extended company, division mentoring and nurturing type of a mindset, collaborative orientation. Again, there's no right or wrong. It's just how you guys operate, your propensity. And the third is agile-like behaviors. These companies like to have on traits like being dynamic, entrepreneurial, risk-taking values, innovation, creative orientation, the open room concept. Everybody's one big open room, and there's very little barriers in this company across. And then you have the startup entrepreneurial, which is companies that are behaving more on the market-based, results-oriented, get the job done, hit your goals. Generally, you have a financial owner, that investor that you are needing to satisfy in these startup and entrepreneurial, and a very competing, very high intense orientation. And so what's interesting is that over half the companies play in the middle, less than 4 the maximum score of 10. And so that's kind of interesting. And a comparison of your company with others would take into account your competition and what you're looking to be in the future. So this is a little bit of a summary of how do you operate. This will certainly help you understand some of your barriers to achieve your annual operating plan and how you should be oriented. With that, what's the shape of your kite? And with that, we'll go into the program deliverables on the virtual supply chain risk and resiliency to support your yearly strat planning. And with that, we're going to talk about the exposure or risk within your business. So we want to most importantly understand your business objectives. And this comes to realize that you have an aligned annual operating plan to business objectives is essential to be able to create that scalable, sustainable growth at predictable cadence in this VUCA world. As we discussed at the beginning of the webinar, we're at, excuse me. At the beginning of the webinar, we're living in this bullwhip effect, and the snap of the whip is cracking. The world is changing substantially. We used to live in more of a cooperative win-win world around the world, but with all the lockdowns by country, we're shutting down. And where we used to have maybe a single source providing consolidated goods and supplies from a couple countries, we now are having undependable, fragmented sources of supply for multiple countries. So that's the world we live in. And you know, we can help with that, help you map that out. And how is that going to be affecting your operating plan? Will using traditional cost methods, will that really work in this upcoming, let's say, next 18 to 24 months, where the whole supply chain will be restructuring? Will cost out alone get you there? Or do you need to be starting to look at some risks? And that's where we can help you. And Greg?
Yep. Jim, we have a question. Thought we'd probably you be better answering the question. It's from RV. Before we get into additional slides, where can I find the recording to watch later after the session? So that's the question.
Yeah, so you'll be able to find it on the consortium's website, as well as on YouTube. And it'll also be on the EIG website. So there's 3 different places you can find it. And we will also email you the link to the recording. So thank you for that question.
Yep. Hopefully we answered that. In this section, we wanted to share with you a couple of additional data points. One is kind of what we call the ugly duckling part of supply chain risk. And that is the financial negative impact to your supply chain and your bottom line. We like to use this. This is a worldwide study a couple of years ago, 2014, 2015, across all industries. They came up with an average number of annual disruptions, no matter who you are, no matter how small or how large. On average, you're going to probably experience 11 different types of supply chain disruptions through, let's say, an annual yearly session. Excuse me. They went farther in this analysis. They took those 11 and applied a cost per disruption. Came out to be about $350,000 US per disruption. You can do the math. it comes out to almost 4 million US dollars that you have to find over a 12-month period inside of your treasury to essentially mitigate these 11 annual disruptions. Why? To survive and thrive. There's more. We'll go to the next slide. Essentially, we want to use this slide. We like to use this slide as an example of leveraging supply chain risk and resiliency to garner market share and revenue. You can do this. Now, what does the slide say? On the y-axis on the left is the value of your organization from low to high, dollar value, your street value, whether you're public or private. That's the value of your organization. On the x-axis again is elapsed time from 0 to infinity. So if on the top left, if that black dot is the start of a risk event, we ask you, which path would you like your company to follow to mitigate that particular risk? And we have 3 paths. The first path is the red line, not very appealing, because what's happening? You're eating into the value of your organization, and stockholders, shareholders, and employees will kind of get very, very unhappy about that. The second path is the yellow path, all right, where it's not as bad in terms of you're losing street value because of your mitigation processes. And then there's a third path, and that's the green path. And we essentially ask the rhetorical question, if you experience a risk event, which path would you want your organization to follow? Of course, it's the green path. And on top of doing well in terms of mitigating risk, you can see that the green path at the end is actually ending up higher than the initial value of your organization. How does that happen? Because if you can identify, assess, mitigate, and manage a risk to your supply chain that your nearest competitor is experiencing as well, and you're better prepared and more responsive, the way that green line ends up above the start is you have garnered new market share and customers from your nearest competitor. That's what it indicates. And the issue is, yes, anybody can do that, but to do that well, you have to learn how to do the 3 things on the bottom. You need to learn how to reduce the time and duration of an event. You need to learn how to reduce the severity and what we call the slope of those 3 lines, because that's impacting your value of your organization. And then you need to learn how to accelerate what we call time to recovery, which is at the end of the graph. So that essentially is what we like to demonstrate to the audience about how you can leverage supply chain risk and resiliency to garner market share and revenue when you experience a risk event. And so with that, we'll move on, talk a little bit about benefits of indoctrinating a supply chain risk and resiliency program, especially integrating it into your AOP. These are what we've witnessed over the last 12 years from supply chain risk and resiliency programs. 1, it's a cost reduction. Yes, the better you are at risk mitigation, you can actually reduce your insurance premiums by 10% or more. It's a beautiful thing. If you automate your workflow in risk management, you can essentially get better at risk mitigation and improve your time to value. There's cost avoidance by doing this well. That's becoming more effective in risk detection than your nearest competitor. And then there's a cost avoidance, which means you get better The more you prepare, the better you are. You become very cost effective in terms of identifying, assessing, mitigating, and managing risks. There's more. If you're good at this, you can improve your working capital. You can be 13 to 15% higher in terms of developing a good cash flow forecasting for your stakeholders and board and so forth, because you're mitigating the amount of surprises. If you do these things well, you're going to free up cash anywhere from 10 to 30%. That's an improvement on essentially what we call a cash conversion cycle, which is next. If you're not using cash conversion cycle as a methodology and a metric, you should look it up. It's free. It's in Wikipedia. We advocate it. You can improve your cash conversion cycle 10 to 20%, and that's inventory days to supply plus receivables days and minus payable days. So that to us is a very good metric of good supply chain performance and risk mitigation. And then finally, what we've seen is we advocate using the Altman Z-score. You may not know what that is, but we advocate it, and we'll give you a quick thumbnail sketch. We've seen that if you have to swap out a key supplier for whatever risk event reason, it's going to cost you on average $1 to $2 to $3 million per change out when it's all said and done. And so what we advocate is we advocate looking at your key suppliers using the Altman Z-score. It's free. It's out on Wikipedia. All right. What is it? It's a bankruptcy probability program. It essentially has a 90% accuracy rate, being able to project financial health, good, bad, or indifferent, 12 to 15 months into the future. And it's free. All you need is income and balance sheet data. All right. Who wouldn't want that as a financial dashboard of your key suppliers 15 months into the future? So essentially, we end up from the benefits point of view saying, think big, start small, and act fast. And with that, I'll move it over to Jim.
Great, Greg. That is very powerful. And so the question is, how do we realize these benefits that Greg outlined, and how do we link those into the AOP? The most likely accepted goal approach out there is Hoshin-Connery planning. Of course, not everyone does Hoshin-Connery, but generally you're going to be following these 7 major steps. The most important aspect of AOP is to make it your own. It needs to fit the cadence of your business, the climate of your business. Understanding your company will often be different cadences based on production buying cycles. So what I mean by that is you have different business units. You could have a business unit that has very short cycles, business cycles, and others that have very long business cycles. So each of these, from a business cycle perspective, needs to develop its own AOP process. And in that, we would inject and embed the supply chain risk and resiliency practices that we're espousing, and pulling out those financials that Greg just discussed. We will next share some best practices here in deploying AOPs that Greg and I put together. So first, again, you need to understand your AOP process. Then you need to assess the risks within each of the business units, and then provide a profile, risk maturity, risk appetite, and culture. And then we want to provide a risk analysis for you and align that to your business, and build a program risk charter, and through checks and points, educate and train and embed risk methodologies into your AOP. The goal, of course, is to have supply chain risk and resiliency to have a seat at the table during your AOP process. So with that, we have another polling question. Do you consider supply chain risk and resiliency within your AOP process? We'd love to get your feedback. Meanwhile, Greg, do you have any comments?
Sorry, Jim, I was on mute. Yeah, we think it's a very novel and interesting approach. We're curious in this question to ask the audience if you ever consider risk when you're putting together your financial budget for the following year. And we think it's very critical, and we think it's a very ideal time to start the dialogue regarding risk for every business initiative. And so that's why we pose the question, just to get some a temperature check from the audience about who and how often do you consider risk within your AOP process. So got a few comments, huh?
Yeah, a few comments. I would say from my experiences, if your company is highly reliant on the supply chain, you're maybe doing some operational risk assessments, but really looking at it from an end-to-end supply chain risk and resiliency perspective. From my experience, we we did not get into those details, going back over my career. We were starting to get into those later on, but the key is that really linking those risks to your financials. Very often it's operationally focused based on operational metrics, but crossing up that line over into the financial world is often very, very difficult to gain traction within the organization, especially the leadership. So that's where we can come in and help you gain that alignment and fortitude and commitment into aligning the supply chain risk and resiliency practices. Greg, any other final thoughts before we move on?
I appreciate the answers. We again appreciate the insight. We always like to see what you're thinking and what you might be exercising within your AOP process. I will tell the audience that many of the exemplars, we know about 300 different companies around the world that we call exemplar supply chain risk and resiliency companies, where they do a lot of things within our book, the things you're learning about today and more. Many of those exemplar companies have embedded the dialogue and some of the methodologies into their AOP process to be better prepared and more responsive and ensure success of their business objectives. So thank you very much for your feedback. All right, we thought we'd finish with a couple of threads in terms of what do I do next. From a program requirement, we can take a look at the ask. What is required within this program, and so we can move to the next one. Basically, 3 hours of your leadership's time over the course of 90 days. We again ask for 5 to 8 executives from your company to fill out the 90 online questions. We like your executives from a certain discipline. We kind of remember we say think big, start small, act fast. So we normally advocate taking a product line which has certain number of stock keeping units or products, and then executives associated with that product line across all the disciplines. You can see them. All right. So we like to advocate focusing on maybe a division or a product line. Again, think big, start small, and act fast. And then on top of that, if you bring 5 to 8 executives into the online survey tool, there's a bonus for you. If you provide 5 or more executives, the consortium will offer 1 free pass to our supply chain risk and resiliency online course for one person out of the company, and that's a value of $1,400 US. All right, so we'll go through one more recap. I won't go through it all. We've explained to you the process. There's 40 hours of online and or face-to-face consulting. You can see the outcome in the middle. You get the charts. It's all computer generated based on your survey answers. And then we go through the process of kind of dialogue with you to make sure that that the outcome is nicely aligned with your AOP, and you feel comfortable with getting the risk dialogue and methodology into your AOP process. So with that, we'll finish up with action planning. Where do we go? Remember, we provide on the left on-demand delivery. We're pretty much virtually oriented. We provide on-demand education. We provide on-demand supply chain readiness tool. We talked about the third element there, our supply chain risk and resiliency action plan assessment tool. We provide online software as a service platforms and journey consulting. So with that, you can contact us with any questions you might have. How do you feel about the program? If you have any questions on anything, you can email Jim and I. The website is below. Think about a product line you might want to analyze and how we can assist you going forward. So with that, I'll turn it back to Jim.
Thanks, Greg. And just as a reminder, this was the first of the series of webinars. Our second webinar will focus on the maturity model. Where are you? On October 25th. So we hope to see you there. And then we'll be completing our series throughout this year and next year. And we hope to see you there and at our future webinars. And as always, we love to get feedback of what you'd like to see more of or less of in our webinars going forward. With that, I just want to thank everyone for joining us and your comments and questions. Greg, thank you for taking us on that supply chain risk and resiliency journey. And Connor, thanks for your support. And just as a wrap up from my perspective, integrating supply chain risk and resiliency within your AOP process will enable you to survive and thrive as the global supply chains unwind and wind back together over the coming months and years. Therefore, it is through the leveraging of each other that we become better and more resilient. Greg, closing comments?
You bet. We think the AOP process is an ideal forum, again, to inject the risk dialogue, get it started, and leverage any risk methodologies, tools, techniques that you can garner to do what? To ensure success of those business initiatives, whether they're your initiative or another discipline's. If you help and assist another discipline in your AOP process to identify, assess, mitigate, and manage a risk to their business initiative, you are going to have a friend for a good long time, from a discipline to a discipline. So we just wanted to mention that again, that we think it's an ideal forum. So thanks a lot for attending, and all the best.